Good afternoon, everyone. Great to be with you again. Brad McBeth here from The Simple Plan. This is The Simple Plan Live. And we've turned that big corner now. We are, it's still officially summer for a couple of weeks yet, according to the scientific climate calendar. But I think in most people's minds, since we're now past Labor Day, we are through summer and into the shoulder season between summer and real fall. So here we are, a grand experiment going on across our country this week, this month, as kids go back to school, and we continue to manage through, muddle through, deal with everything that's coming out of this COVID-19 pandemic. And whatever your opinion is about all that stuff, it is truly having a profound impact on an awful lot that's going on. So today, I want to kind of revisit a topic that we spoke about a few years ago. I did some programming on this, but it's really critical to so many people and potentially a real bomb there to go off in your finances if you're not aware of it. So we're going to talk about the problem with your mortgage insurance and why it may be a much bigger lurking disaster for you than you think. As always, you can find us on Facebook at Macbeth Group. You can also find us always on Instagram at Macbeth Group, on Twitter at Cash Coach Canada. And our sponsors today, thanks very much to The Simple Plan Life Insurance. You can find them at getthesimpleplan.com/quotes. We're actually going to show you a little bit of that today. Not much, but just a little. Because after this program, you may want to run there and get some new information. And if you're not sure how much life insurance coverage you should be carrying to protect your family's way of life, you can find that out at getthesimpleplan.com/how much. There's a calculator there that's easy to use and a little movie even on how to use it that will help you figure out how much life insurance you should be carrying. Now, our special tool today is Better Mortgage Insurance. We're going to talk about that, what that all means. You can find it at bit.ly/SPBetter. That's bit.ly/SPBetter. And so we're going to check that out a little later. Maybe step through it a bit. We'll see how that's going. I think we might actually take a little peek through it. And so I just want to kind of help position in your mind what this mortgage insurance is. Now, what exactly am I talking about when I say mortgage insurance? Because that can bring two things to mind for people. One is financial insurance that allows you to get what's called a high ratio mortgage. It's put out by Canada Mortgage Housing Corporation, CMHC, or I think there may be one or two other insurers left in the marketplace in Canada. That is not what we're talking about. That is mortgage funding insurance, if you will, that protects the banks in case you don't pay your mortgage. What we're talking about is creditor insurance or life insurance, mortgage life insurance, though the same thing applies exactly to credit card insurance. Now, you may or may not even know if you're paying for those things. If you are, and here's how you can find out. On your mortgage, you should be getting at least annually a mortgage statement of some kind from your lender that shows you how much you're paying, how it breaks down, what's principal, what's interest, all that kind of stuff. And there would likely be on there as well an indication of the premium you might be paying for the life insurance that's associated with your mortgage. Now, the reason you may not be aware of whether you actually even have this coverage is because it's so simple to get. You may not even have paid much attention. So, for example, when you went and got your mortgage, there was a day that came where you went in and signed a whole bunch of papers. And in one of those days, there was probably 2 or 3 of those types of days as you were going through your real estate transaction. And if you were selling a house, there was more of those as well. So when you were doing the mortgage portion, you may have been asked by the person that was completing your mortgage application or the signing of the mortgage documents, what have you, whether you wanted to get mortgage life insurance. And Of course, it sounds like a good idea. If something happens to you, you want to protect your family's way of life, sure. And it's dead simple to get, seductively so, at the time that you take out your mortgage. Because normally, they'll say, well, do you want mortgage insurance? In fact, they may even ask the question in such a way as to make you feel like you have to have that coverage. Let me tell you unequivocally, you do not have to take that coverage under any circumstances. In fact, you don't have to have life insurance of any kind. They cannot make that a requirement when you're getting a residential mortgage. That just doesn't happen. Now, that doesn't mean that they don't word the question in such a way as to make it sound like you must have this coverage. And a lot of people I talk to, long after the fact, go, well, yeah, I think it might have been mandatory. It cannot be mandatory in Canada. That is not legal. And so if you were made to feel that way, that was simply a underhanded marketing ploy. So that's the first thing. Now, the other thing is when you take out this mortgage life insurance, they're only going to ask you a few questions. And this is where the problems really begin. So they're going to ask you, could be 4, 5, 6, 8 questions, probably on the lower number side. And they're going to be questions about your state of health and whether you've had any dread diseases historically. They're going to ask whether you smoke because that affects the rates. And it's not going to get much more extensive than that, but they'll ask you some questions like, well, have you had any diagnostic tests in a certain period of time? And it's these questions that are problematic, and they're problematic for 2 reasons. One, because those questions, whenever you're applying for insurance of any kind, are a little tricky and not intentionally so. They are not intentionally tricky. They're often just kind of sloppy, or they're a little unclear. And so when you get regular life insurance from an insurance broker, you're dealing with someone whose profession it is to do that, and they are expert at knowing these questions, understanding them, asking them, and making sure that you're answering correctly. Whereas when you get mortgage life insurance, you may well have been sold that by a mortgage broker, or perhaps just some form of administrator or clerical person in a bank. And so they don't really know anything about these questions. They're just asking the questions, and they're taking down your answer. So one of the big distinctions, and there are several, but one of the big distinctions between mortgage life insurance and typical term life insurance, conventional term life insurance, is that the mortgage life insurance only asks a few questions up front. They don't do any checking on your answers. They don't underwrite. That's called underwriting your application, when they review all the answers and then make a decision about your insurability based on that. They simply approve or deny the coverage for you based on those few answers. When they do the investigating is if you make a claim. So let's say, for example, you're 5 years down the road and your spouse passes away, and you have this mortgage life insurance. Now you're going to go and submit your claim to try to get this payment. That is then going to trigger them doing their underwriting. It's called post-claim underwriting. What that means is they're not actually doing the investigating until you make a claim. That means you're not actually going to find out whether you really have this coverage until you apply to get the benefit. So what happens here is they may go through and they go, well, you said that you did not have any kind of a diagnostic test in a certain period of time, whatever the question was. They go back, they investigate, and they find out that, you broke a finger a year before, and you went and had an x-ray. Well, an x-ray is a diagnostic test. You said on your form that you did not have a diagnostic test in that period of time, and so they may now deny your claim. And if you think this sounds ridiculous, it is, but if it is not far-fetched, I assure you. And I'm going to show you some links to some programming that'll give you some understanding of that. So now, of course, your broken finger, the broken finger, and it's not for you, of course, it's for the deceased person. The broken finger on the deceased person has no bearing whatsoever on their health. It didn't kill them. It didn't kill them later. It was not anything that affected their health or caused their death. However, you did not answer the questions correctly. And so what they will do is they will deny your claim, and they will then refund all your premiums. They'll just say, well, you never should have had coverage because you had this, well, because you didn't answer the question correctly. All right, so what you're finding out the hard way is that what you thought was whatever your mortgage amount was at that time, $250,000, $300,000, $500,000, $800,000 worth of coverage that you've been paying premiums for all these years, you are not covered and you're not getting a check. And that could leave your family in a very difficult situation financially. And so this form of insurance, as I said, is called post-claim underwritten insurance. It's the same whether it's mortgage insurance or it is the kind of insurance you get with your credit card, like on your credit card balance, and whether that's the life insurance coverage or what they call the disability coverage or the critical illness coverage. So that's the biggest problem with this type of coverage. Now, there's another problem, and that is that the amount of coverage on the life insurance portion is declining. Well, why is that? Well, it's because the amount of coverage you have is for the balance of your mortgage. So the day you took out your mortgage, maybe you took out a 25-year mortgage. The day you took it out, maybe it was $250,000. Fast forward 10 years, you're still paying the same premiums on your mortgage life insurance as you were when you started out. But now it's not covering the same amount anymore. Now your mortgage balance is perhaps down to, $180,000. So while you might have been paying $100 a month for your $250,000 worth of coverage, you're now paying $100 a month for only $180,000 worth of coverage because the face value of the insurance is the amount of your outstanding mortgage balance. Now, later on, it gets completely absurd. So let's say that you get down to having 5 years left on this mortgage and you haven't really thought about it. You've just continued to pay those insurance premiums. Well, if you've only got 5 years worth of payments left on your mortgage, you're probably down to owing $40,000. Maybe it's $60,000, doesn't really matter. But now you're paying for a quarter of the amount of coverage that you were paying when you started. You started at $250, you're down to $60 or $50 or $40 or whatever, and you're still paying that $100 a month for the coverage. And that's going to be carrying on if you have not thought to investigate this and to adjust your coverage. So that's problem 2. The amount of your insurance is declining constantly from the day you start making payments on your mortgage. Now, the third problem is they're not going to pay your surviving family members, your spouse normally, but they're not going to pay your surviving family members the money. They're going to pay the bank. And yes, the bank is going to pay down your mortgage. They'll pay off your mortgage. But here's the problem. Let's say they've paid off that mortgage, but you really needed some money to float through the next 6 months, to have some options, maybe to take care of your kids or take time off work or whatever it is. But they didn't write you the check and give you the option to do with it as you would. That check just got written to your mortgage, the people that hold the mortgage on your house, and that mortgage got paid off. So they're no longer owed anything, but you didn't receive anything. And you go, well, yeah, it's great though. My house is paid off, and that's true. But your ability to get credit against that now may be severely impaired because perhaps the person who passed away was contributing a significant amount of income to your family's way of life. So there you have problem number 3. It's not real. It's your life that the insurance is on, but it's really the bank that owns the insurance. They're the ones who are going to get the money. Now, you're going to get the benefit of your mortgage being gone for sure, and that's obviously very big. But you're not getting the flexibility that you would have if you had your own insurance coverage that was writing you a check directly for the face value of the coverage. So you've got 3 big problems there. The first is, the biggest one is, you don't even know if you really have coverage. You won't find that out until you submit a claim. If you never make a claim, of course, you'll never know and it won't matter. But to find out that you were not covered because of the way the questions might have been answered is a complete catastrophe financially at probably the lowest moment of your life. Secondly, the amount that you're insured for is declining constantly. And then thirdly, you're not going to get the money, the bank is. So these are all problems with mortgage life insurance. Now, if you think I'm exaggerating, let's look at some of the issues. Now, let me just say first that the same thing applies to credit card insurance. So if you're paying that credit card insurance on your statement monthly, a few things are applying. The same things are applying there. First off, the underwriting on that has never been done. It's not going to get done until you make a claim. Secondly, in the case of the life insurance, it varies. For some, it will only make your payments. In others, it will actually pay off the balance. On the critical illness and disability side, it's only going to make your credit card payments for you. It's not paying you a significant amount. It's just making your minimum credit card payments. So, yeah, that's nice. You don't have to worry about it. But of course, the interest is still accruing while they're doing that. Once again, you have no control over that money. And those premiums are not inexpensive. You could be paying $50 to $100 a month for not very much coverage. So if you think that I'm exaggerating on these fronts, let's have a look at a few things that are going on around globally. So this is out of Australia, where they've unearthed or revealed a lot of the problems that are going on in this kind of credit insurance market. There's class action suits down there. So pitiful payouts from junk credit insurance sold by major banks with loans and credit cards. Oh yes, this also applies to loans, not just credit cards. So it's a big problem. And in fact, there's a major class action suit going on there. I'll post the links to this so you can read it for yourself. Now, another interesting thing is that Australia did some research a number of years ago. In Australia, there was some research done, and it turned out that the payouts on mortgage life insurance were being declined in the 20 to 25% frequency range. That means that 20 to 25% of people who made a claim for the life insurance on their mortgage when they got the mortgage life insurance were being denied because of the post-claim underwriting. Now, you compare that with traditional life insurance where the underwriting is all done up front once it has been issued. Unless you've committed fraud, you're going to get that payout if the person passes away 99% of the time or better. But in Australia, I don't have corresponding Canadian numbers, but we can imagine they may be similar. In Australia, 20 to 25% of the time, those mortgage life insurance claims are not being paid out. Now, if you want to check out what's been going on, Marketplace, that Canadian television show, did something back in 2018 about people who've been and this is another angle on it, people who weren't even aware that they were paying for this type of coverage on their credit card. So they're paying for life insurance and what have you, and they've been paying a lot of money for many, many years. CBC ran a story back in 2020, back in April 2020, guy who got a $7,500 refund of the insurance money that he had been paying, or the premiums he'd been paying for the insurance on his credit card. He says that he never agreed to do this, and the bank was not able to produce any evidence that he had ever agreed to this. They just enrolled him and started charging him. So you might want to check whether you're actually paying and whether you intended to pay. The other thing to think about is if it's $7,500, he's obviously paying a significant amount of premiums for this coverage. And think about that. It doesn't take much to do that. If the premiums are even just $25 a month, and that would be quite low for that type of coverage, $25 a month, that's $300 a year. 25 years, you might have your credit card. There's your $7,500. All right. Now, Marketplace also did. This is old. This is from 2008, but things have not particularly changed. Marketplace did a fantastic expose on this problem with mortgage insurance in 2008. It's called In Denial. I'm going to post the link for this in the comments section, so you can go and watch it yourself. But if you just even Google CBC Marketplace In Denial, you'll find this, and you can watch the whole program. It's about 27 minutes. It explains the entire problem with this mortgage insurance and why, and it gives some tragic but very sobering real-life stories of people who've had this problem. Now, what's the answer to this? Well, the answer is to have real mortgage insurance. And so what do I mean, or real life insurance? And what do I mean by that? Well, real life insurance is life insurance that you fill out, a fairly extensive application on. There's a bunch of health questions, maybe a test or two, though often not these days especially. We've talked about that before. You may be able to get up to $2 million worth of coverage without going through any testing, poking, prodding, what have you, depending on your age. But that coverage, you answer a lot of questions, and there's an underwriter who reviews it all. They may request medical records from your doctor to check things out. And then when they're going to issue that life insurance, but now that they've got it, here's what happens. First off, it's been issued, so they can't go back and say, well, we didn't like the way you answered that question, unless they can show that you actually tried to defraud them with an incorrect answer. Now, you generally won't have an incorrect answer because you'll have worked through this with a mortgage professional, an insurance professional who is expert at asking these questions for all the different companies. So that policy, once it's issued, it's issued. They're not going to go back and do more underwriting after the fact. There are a couple of exclusions. There's a suicide exclusion clause in the first couple of years. So, and again, if you in any way lied and they find that out, they may, in the first couple of years, be able to decline. But unless they can show overt fraud, even after 2 years, if you answered incorrectly, they do not have any recourse to go back. So that's number one. Number two, the face amount of the coverage is always going to stay the same. If you bought $500,000 worth of coverage, you are going to have $500,000 worth of coverage. It's not declining. Number three, it's generally much less expensive than the mortgage insurance that you're paying for on your mortgage, or certainly the credit card insurance you're paying for on your credit card. And that's because they've done all the underwriting. So they've evaluated the risk based on your individual circumstances rather than just on a few questions that got answered. And so, and finally, should you pass away or your spouse passes away, they're going to write a check that your named beneficiaries can do anything they want with that money. So they can pay off the mortgage if they want to, or they can put the kids through school, or they can pay to take a year off from work and try to recover, or you can use the money to stay home and care for your children if they're young. All those things, those are your options. It's up to you what you do with that money. That money is yours. So that's what I mean when I say better mortgage insurance. So what I want to show you now is the option you may have for better coverage. Now, this is just one company's tool, but it's probably the simplest and fastest way to get this coverage to replace your mortgage insurance. I'm going to also show you a way that you can get more comprehensive quotes from a whole bunch of companies. This is one company. It's called Assumption Life. So let's flip back over there. So this is their site. Is called Better Mortgage Insurance. And again, we're talking about the links for you, and we'll post them in the comments. So there's a little video here that explains why your mortgage insurance is a problem, basically elaborating on the same topics I've been talking about. And so in their case, you can get term life insurance plus disability insurance plus critical illness insurance if you want all that coverage. You can also just get term insurance if that's all you want, the term life insurance. So all you're going to do is put in some information about yourself. So we'll take a fictional person who is, 1980, we'll make them born July 16th, 1980. Make it a male, non-smoker. Oh, one other point, interestingly, about the mortgage life insurance. The rates are not differentiated with some of the companies based on gender. And so generally for life insurance, women pay lower rates for the same age and amount than men do. So women, if you're getting that mortgage life insurance, you're paying through the nose even more. All right, so are you a smoker? Are you unemployed? The reason they ask that is because the disability portion may be tied to your employment, the amount of money you make. And they want to know if you work more than 20 hours a week. Again, that's a question relating to the disability coverage that you may be getting. All right, so we've said this person's working full-time. All right, so tell us about your mortgage. So if you've got 20-year mortgage, so they're going to get you 20-year coverage. We'll make it Ontario, and we'll make it $250,000 mortgage. And their current monthly mortgage payment, again, this is for the disability portion. So, gosh, what's that going to be these days? Let's call that $1,300. That $13,000, that's too much. There you go, $1,300. So you just, the basic information, and it's going to calculate, and it's going to show you. We'll close that. So you could fill out that form to get more information. That just comes to us, by the way. So we'd be happy to send you more information. So you can see here what the projected amount is that you would be paying for that $250,000 worth of coverage. And you can see it even tells you how much you'd be saving compared to getting typical bank mortgage insurance. And so you can go with the basic, which is just the life insurance, or you can go with the pro, which is the life insurance and the disability insurance, or you can go with what they call the premium, which includes critical illness insurance. By the way, you generally cannot get all three combined in a mortgage life insurance policy in Canada, but you can obviously own all three. So that's just a quick tool, not sitting here to flog that to you. I just wanted to show you how simple it is to use to go and get a quick indication of how much money you might be saving by going with a different product. Now, the difference is, so yes, you're saving $20 a month. So in this case, that's about a 40% discount. But here's the thing. The face amount is going to stay the same, and you own the coverage. And this is another problem with your mortgage life insurance. If you switch mortgage providers, you may have to switch mortgage insurance providers if that's what you're using. And here's the problem. You're going to have to answer those questions again. Well, what if things have changed? What if you can't answer one of those questions the right way any longer? You've developed diabetes, or you've had cancer, or something else. You are not going to qualify for that mortgage life insurance any longer. So you're now stuck with your existing mortgage provider, if that's even possible, or you're going to be without coverage. Whereas with this, when you buy the coverage, you own the coverage, you've got the coverage, you keep the coverage. So even if you develop some illness down the road, you're not going to lose the coverage. So that gives you, you would then select, and you can request to have the quote emailed to you. Phone numbers there too if you want to call for help. So that gives you an idea of how you can go and just very quickly check out whether you might be able to do a lot better with your mortgage life insurance than you're doing these days. Now, again, this is simply one company. It's probably the simplest company to apply through in Canada, called Assumption. But if you want to then, if instead you prefer to shop for what might be the lowest rate, you can go over to our site, we'll talk about it again, at getthesimpleplan.com/quotes, and you're going to be able to go and find out how much you would pay over here. So let's just quickly compare. So 16th of July, 1980, $250,000 on a 20-year term. All right, so let's go over here. All right, I got to get that again. 16th of July, 1980. So July 16, 1980. So we've got a male non-smoker. We'll just get the regular rates, 20-year level term, $250,000. We'll need an email address. I'll just put ours in there. Whoops. All right. All right. So you see, you could actually get it a little less expensive still, $28 a month instead of, what did we say over here? $33. So you could save an additional $5 a month by shopping the market. I said British Columbia. If I put Ontario, it might be a few cents difference, but it'll be the same, more or less. So that gives you an idea of how you can quickly go and save yourself some serious money. Now, what do I mean by serious money? Well, first off, you can avoid the possibility that you are not covered at all, because with your mortgage life insurance, the underwriting is going to happen when you make a claim, not beforehand. So you won't even know if you're properly covered until then. Number two, let's say that you can save $10 a month even on this. Assumption said it would be 20, but let's say it's half that. Let's say it's only 10. All right, well, that's $120 a year. Fair enough. But if you're on a 25-year mortgage, 25 times 120 is $3,000. So that's a $3,000 savings right there just for taking a few minutes to check things out. Never mind the fact that you're now going to be sure you have coverage. The coverage is going to be for you, not for the bank. And it's going to be for an amount that's fixed, not an amount that's declining every single month until it gets absurdly low. So that gives you an idea of what this is all about in the mortgage insurance department. Now, we did, I'll just show it to you here. We also did a blog post on that a while back. So there's a video. Of course, you've heard all this here, but you can watch it in a different form through our blog. I'm going to post those links. You can go see the programming on Marketplace. You can read the articles. If you've got mortgage life insurance or credit card insurance, you really shouldn't have it unless you are uninsurable any other way. So first off, let me reiterate that. Don't cancel any coverage you've got until whatever it is, until you've put replacement in place. But you should go and get that replaced. And once you've replaced it, cancel that. You're going to save yourself a lot of money, and you're going to be able to have the peace of mind that your family really is covered. So I want to thank you for watching today, a little bit longer segment just to really get this out here about the mortgage life insurance and credit card insurance thing. They're awful, awful products. In my opinion, they should not be allowed to be sold the way they are. Sadly, they are. And a lot of people are finding that out the very unhappy way. And you know what? Even if you never find out the unhappy way that you weren't covered because you never make a claim, you're going to have paid probably double over the lifetime of that policy, the lifetime of your mortgage. You're going to have paid double what you would have for proper insurance coverage. So again, you might save $3,000, $4,000, $5,000, $10,000 over the life of your mortgage, or more, depending on the size of your mortgage. All right. Well, that's it for today. I want to thank our sponsors very much. The Simple Plan Life Insurance. You can get quotes, as you saw today, for all your insurance, your term insurance needs. Get thesimpleplan.com/quotes. If you aren't sure how much life insurance coverage you should be carrying, you want to know how much you should have to really take care of your family's way of life, you can go to getthesimpleplan.com/how much, and there's a calculator there. Again, today's helpful tool, that's the Better Mortgage Insurance tool. It's a great place to start. And you can get that at bit.ly/spbetter, bit.ly/spbetter, and that's all lowercase. So I want to thank you very much for spending the time with me today. I'm Brad McBeth. Again, you can find us on Facebook at Macbeth Group, or you can find us online at Twitter, Cash Coach Canada, and on Instagram at Macbeth Group. Thanks very much for taking the time to spend with us today. We're here to answer any questions you have, so please send them our way. Always happy to answer whatever questions you have. Thanks. We'll see you again.